All right, so welcome to the weekly live show. Uh, I think I will start because between the people that attend every week, thank you, or most weeks, and the people that uh, will regularly listen on the recording, which usually goes out the next day or tonight. Uh, I want to make sure everybody's on the same page because we're getting a lot of questions and things. April's kind of a transition month. Not that it has slowed any of the work for sure. I think if you've looked at roar.pytrade or if you've seen the amount of stuff we're putting out at ETF yourself on Substack, you have a pretty good idea that we've been busy. And but we have been. Sort of gradually, gently navigating that transition from the Seeking Alpha investing group, uh, where we've been for a while, back to where we started at ETF Yourself on Substack, where we have a basic level of subscription, which is pretty much my writing on that platform. And then what we've done in place of the investing group is to offer more and cut the price almost in half, I think. $600 a year. It's $600 now. It will be going up, but we want the people that know about it to get in now. That's why you see that coupon on there if you sign up. But just so people understand the difference, those who want my writing on Substack and that's it, snapshots of this, whatever. Um, that's the basic Substack. The folks that we're talking to here, I think, and hopefully others to come, uh, the $600 a year price is obviously includes everything else on there, uh, on the ETF yourself. It includes the entire Roar Pie Trade site, obviously one-click access to Pie Trade, where some of you have been copy trading, which is great. We got a lot more coming. Obviously, you can see those models, and um, and then you also get this, which is the live weekly. And really, what we're trying to do, and I mean, it should be obvious, but we're happy to have people just you know do the reading of the Substack. But I feel like at this stage of my career, there's a lot I can offer that goes beyond posting articles on a big platform like Substack, great as it is. So glad you're here. And if you've been with us in Seeking Alpha, the investing group, whether it's people that joined recently, people who've been here since the first time we were on Substack, and now we're going back, um, we'd encourage you to make the move back over. The one thing that Dana and I have been trying to figure out, because technically, as we understand it, on April 30th, which is a week from Thursday, today's 21st, uh, on the 30th, that's supposedly the last day that the investing group at Seeking Alpha will uh, will exist. They're going to close it down. What we don't know is, and we're going under that assumption, and we're posting there things there now. The weekly roar came out earlier today. Next Tuesday it'll come out, and that's about it. I mean, maybe there'll be one more post off Tuesdays, Wednesday or Thursday post, but that's it. So you really should be getting all of your um writing and news from Rob, if you will, at ETF yourself on Substack, so etfyourself.com. And you also have full access to the analytics site, roar.pytrade.com, which uh, is obviously being enhanced a bit every week, really focusing on those model portfolios, which I will go through with you today. as part of this session. I put out a piece yesterday that, frankly, I think if we look back a couple of years from now, um, the piece I put out yesterday might be one of the most important pieces I put out, and it probably didn't look like it, but it was because the problem that Dana and I have been trying to solve, along with whoever's been working with us over the last 6 years since we sold the advisory practice and, retired. I don't look retired, do I, based on the activity level? And I'm not. But retired in that sense. Uh, Ever since that time, we've been trying to figure out, like, what can I take my skill set and do with it to project to be able to help people? And they'll pay us for it, but not like they used to. So the more you can tell us about what you think for you, and if you can speak for what you think people like you would like to experience, let us know. Because the great thing about our friends at Pie Trade, who we talk to obviously very frequently and are constantly doing things to engineer the site. But the other thing we're looking at is, look, they're a fintech, startup company. They're getting, toward the end of what you might call startup mode, and they're raising capital and things like that. So they're trying to go to the next level. Um, and they weren't really expecting, until they met us, that they'd have more than the copy trading platform, the pietrade.com, which is an app, and a great app. But when they met us, and all of a sudden it's like, oh, wait a minute, you got this whole ROAR thing and a whole system of managing risk and a whole thing. And oh, yeah, we've run portfolios for 30 years. Wow. Instead of just plugging you in as one of our strategizers on PieTrade, why don't we create a whole research site? And that is the short story of how we got to exactly where we are now. And so um, I really cherish having this focused group of what I like to call the inner circle. That's all you folks who either are, I mean, if you're an active member of the soon to be former investing group, now flipping over to the other side, but you're still part of this weekly session, either attending live when you can, regularly listening to the replays, or just interacting with us. Okay, we enjoy the interaction because we aren't able to read the minds of the people that enjoy and get the most out of our work. And we are highly collaborative. And one thing I can say about the folks at Pie Trade, of which you've met Priyanka, the CEO, and she'll be on again with us soon, I'm sure. But And by the way, she's a former Goldman Sachs quant analyst, so it's not like she doesn't know what we're talking about. Okay, but super bright, and so to us, it just seems like we are still kind of an open playbook here for people to use, and the fact that you are the early adopters still, okay, and the inner circle, and we're not giving you personal advice, but we're getting to know from your questions just the general nature of who you are. Um, the more we can do to to push that further down the road, just tell us. At some point we'll probably do some type of survey, or maybe even like a small group or even one-on-one calls, and just to try to figure out what people want. So I wanted to make sure that was clear in this transition. And just in case you were bored with any of that, I kept this stuff up here. So you can see this is one of my favorite parts of this thing. We're going to streamline this a bit, but we want to, our habit is, when we have something that we think is going to be interesting, we put it out there, even if it's not in perfect form. This should be a little bit more organized. I mean, it's pretty organized, but still, it's a lot of colors. Do you really know how to use it? And so that's where I'm going to start today. Uh, now that we have talked about it. But look, bottom line on everything I just said, um, if you're in the Seeking Alpha group, um, as we understand it, about 10 days from now, there will be no Seeking Alpha group. We have your emails, or if we do, I should say for maybe half of you, we have your emails. You're already with us on Substack, so no big deal for you, hopefully. But for the others, if we don't have your email, info@sungardeninvestment.com is a good place to send it because there's at least a possibility that once the investing group is cut off, yeah, we can send things out to people through their blog service, which is great. And I'm doing a lot of writing there now, as I expected to. But in order to stay in touch with us, it's going to help to have an email. So if you don't, if we don't know your email, and you want to continue to follow our work in a way that is more than just kind of running into it out there on the World Wide Web, see if you can connect with us. All right. I hope there are some questions today because, I mean, what I've got to go through here is fairly straightforward. I can't tell you there's a lot going on uh, other than what we've had going on. And as a result, it just keeps feeding more and more into this narrative of mine, which is I'm not so sure that investing is ever going to get any more complex than it is right now. And I think it's getting simpler by the day. And I don't mean simpler to succeed, I mean simpler to decide what your playbook is, what your tool set is, what your strategic approach is going to be to getting whatever it is that you want out of your portfolio, which is just a way of saying what you want to get out of life using the money that you have and the money, you'll grow it to. And the key, of course, is not losing big along the way. That's our thing. So when I look at the current market, yeah, I mean, you can see, is there really that much of a difference between what you do at the sector level, which is what the first 11 are that you see down here, okay? These are all the sectors of the S&P 500, and then the subsectors. And frankly, one of the things we're looking for feedback on is maybe we're feeding you too much information, too much analysis. And look, I always like to think out loud because again, you folks are the inner circle, so you're going to help us drive, the ability to deliver whatever it is going to help people like us and hopefully many more as we expand the reach here. So I'm looking at this and I'll tell you, the more I become sort of Mr. Simplification, and by simplification, what I mean is, look, when I show you how well that two ETF portfolio of SPY and Bill is doing, and then I say, oh, if you just add VIXI to it and you leave room in cases of high risk that you can not just put a lot in cash, but you can put a lot in cash and you can have this sort of exogenous small position in VIXI that can take an S&P position of 20, 30, 40% and neutralize it in one really bad day in the market because it goes up like this in a straight line sometimes. It's like, I think the biggest challenge for people that manage money, whether they're doing it themselves or that they do it professionally, as I did for years, the challenge is going to be trying to see if the time you spend beyond doing that simple 2 to 3 ETF approach, if the time is going to be worth it. If you enjoy it, the time is worth it. If you're doing it saying, oh, well, if I just pick these stocks and if I got to find the next Amazon, I got to find the next Nvidia, okay? Maybe you will, but the idea that this is going to be like a full-time retirement occupation for people the way it has been, I think ETFs, I think markets moving the way they do, influenced by so much money going to SP indexing. Um, and of course, the algorithmic trading. And I mean, arguably some of the stuff that's going on where, gee, who knew about that before the announcement came out that it spiked oil by 10%? Wow. Isn't it funny that somebody made a huge trade right before that? I mean, that's the other element, which we won't talk about today, and I don't want it to get political, but it's added another sort of feature or bug, if you will, to analyzing the markets today. And a lot of it, frankly, is just flattening out. And this is from somebody who spent, the better part of 40 years digging into securities. And what I'm telling you is not that it, I'm definitely not saying, well, put it in the SP 500 and buy and hold. That's the opposite of what I'm saying, because that is taking big risk. What I'm saying is the basic idea of let's first avoid big loss and let's try to make as much as we freaking can. Uh, that's always been my goal, one and then two, or one and 1A, if you will. Trying to do that, we can cut right through. I think I've used this expression before, sung by a great band called OAR. You go over, you go under, you go around. I go through. I go through. And more, that is leading me to exactly what you are seeing on these model portfolios that I have built, that we have stress tested, back tested, not with the idea of making them look better in a back test, but making sure that they were true to my investment approach. Because Roar analyzes the charts, but that's only half the battle. Then you have to collect things together and make your portfolio, like a well-functioning sports team or organization, et cetera. So, and we're realizing not a lot of people think like this. We do, I think. It's part of the reason you're here, but most people don't. That in itself is an edge. Not maybe today, tomorrow, next week, but it's an edge over time because the markets will change. And when they do, you're going to have some people who are like in their brains working around the clock worrying about money because they still think the markets are, stock picking and this and that. Okay. All has value. It all has value. But relatively speaking, when there's only so much time in a day, a year, or dare I say a lifetime, what I'm trying to do as much as anything as a researcher, the research side of what I do, which is at the core of all of it, is to try to figure out, hey, do we have to make this so difficult? Roar helps a lot because it helps define when there's major risk. It's much better at defining where there's major risk than finding the highest returner. But if you avoid big loss, remember, your returns are likely to be much higher over time. That's always been my belief, and it works, except when the market goes up 15% a year for 5 years. In those environments, you'll probably trail if you follow my lead. Other than that, probably gonna have a much more comfortable and dare I say confident investment experience. So, what does that mean here? I'll get to the portfolios in a couple minutes, but it means that, and this is really the question I'm asking. It's like there's like 75 of these things here. Okay. Dare I say, I'm not sure that we're going to need more than 20, 25, or 30 of these. Okay. I mean, I would love to think that you can buy the video gaming ETF with some companies that I probably am not too familiar with, other than maybe EA Sports and stuff. But, and you can see in a market environment like this, okay, it flops up and down a lot. This is one of the things, just because we put the Roar score out there doesn't mean that we are ever satisfied with what we put out. Okay. It's great that this is what it does really well. I want to make sure people really understand what Roar is and what it isn't. Okay. Because sometimes we'll get the question, and it's a very understandable question. Like, well, the score keeps changing. Yeah, the score keeps changing, but you notice how you didn't see green from here, 115, I just picked this one out. I could do this with anyone, and I'm happy to. But okay, at 115, not the top, but at 115, the chart was starting to turn. It wasn't green anymore. Okay, and by here, it was kind of dead red. And what was that number? There, 115 and change. Okay. Well, that told you that risk was very high. Didn't mean it couldn't go from 115 to 125 or 150. But there was a much better chance that the bottom could fall out. Doesn't always happen. Here it did. And you see, that's quite a colossal loss. Well, this is one security. I think where now that more people are using Roar, the biggest mistake I think people are using with it, and frankly, it's helping inform what parts of the site get reined in. And this is where I could really use the feedback. Like, do you need all this? Okay, or do you really need a collection of these with some limited ability to be able to go in and say, oh, okay, yeah, I can look and see, what's in here. I don't know if you can click on this. No, I don't think you can click everywhere just about, but yeah, I mean, if I want to look up a security, I can. But what I hope, and actually here, let's see, I think, yeah, Q's is actually a good one. And hopefully, I'm making myself clear here. Okay, I actually pinged the programming folks at RoarPie Trade a little while ago because I said, this is like the one part of Roar that I think could be misinterpreted and that we could probably re-engineer a little bit. Okay. If you've looked at the portfolios or you read my post yesterday, you know that when you use Roar scores in a portfolio context, allocating amongst a set of securities, here's 10 stocks. I'm going to own most of them most of the time, or here's 10 ETFs. I'm going to own all of them at each point in time. It's just a matter of how much. That's what this is built for. Now, the secondary use of it is what I was just describing. And if we look at the NASDAQ this year, yeah, does it get it right most of the time? I think it gets it right most of the time. Is it perfect? Is it a buy and sell trading system? I'm not ready to use it that way because this is about risk management, not about speculation in the short run. So what it's looking to do is trying to figure out. Okay, I've even discussed with them. Maybe it should be mostly yellow, and other than the yellow, and this one does a decent job, but like over here, okay, chances are the chart was good, but it wasn't phenomenal. It was maybe phenomenal for a brief period of time here. You see, it's only a 4% move, but whatever. Okay, there's a lot of time where there's not going to be a major move either way. And of course, the NASDAQ maybe not the best example because it doesn't tend to crash that much. But when it did, when it was really turning from bad to worse, it was on it. Okay. The problem here is that the move didn't last long enough. I'm sure if I go to something like Oracle or whatever, we'll see it. Okay. And then here, it's also a little slow on the way up because that's technical analysis. We're not trying to call tops and bottoms. I learned this as a technician a long, long time ago. As a matter of fact, probably from my dad. Um, that technical analysis is not the business of calling tops and bottoms, even though that's what everybody loves to turn it into, along with every other part of investing. But that's just speculation and trying to create excitement. The idea of technical analysis is to get the fat part in the middle right. And that's what this is built to do. Um, so you're going to get moments like this. And granted, we've got such a news heavy market, which we never had before. I mean, one tweet, every announcement out of the Middle East, right? Today it was, JD Vance and the team are not going to go to Pakistan. Boom, straight down. Okay. We've always had this, not like this. This is like a 10x on that. As a result, the Roar score, which is a bit smoothed, okay, it's like about 10 days smoothed, it's not ready to react yet. It just got here. And so when you get these whipsaw markets, that's more likely what is going to happen. I mentioned Oracle before, and that's probably a good example, especially what it's doing now. Okay. So, and let me go back a little further. Let's see, would 3 years do it? It might be too much. No, it's not bad. Okay. So this is what I'm saying, and this is kind of like this is not just for these. This is for all securities. This is using ROAR. Okay. Um, so you see a lot of color changes here. All right, but to me, the most of this is just they used to call it back in the brokerage business backing and filling. Okay. Stock price is going up, going up. Okay, and I think backing and filling had something to do with like the market makers, like when somebody's trying to get a big order in, yeah, they push the stock up a little because they have so many shares that they're buying, and then it recedes a little when they buy a little more. I think that's what backing and filling is, an old term. Dating myself, but okay, see all this just noise to me, and so this is where we could really use a lot of uh, input from you folks. If this thing were, I would say, neutralized, I don't know, maybe we come up with a gray or something to say no defined trend, something like that. Okay. Yellow's the in between right now. But the idea, because we want this to be as precise as possible. I'd say it's 90% as precise as we'd like it to be. But when markets go nowhere for a while, like Oracle did before all of a sudden it started going in every direction, okay, this is very colorful, which is nice, but it's not helping. Okay, but it does figure out when things are about to go from bad to worse, most likely. Okay. Even here, where it was, see, the green caught the part in the middle. What I'm looking at basically and asking you is maybe smoothing this out a little bit. Okay. Maybe it would take a little bit of the edge off of, you know, some of the decisions and make it easier to use at the individual security level. I am highly, highly enthusiastic about what this approach is doing for portfolios. But as the equivalent of a buy, sell, and hold metric, I just think there's so many other issues there. And all you have to do is look back. I just wrote an article, I think, for Seeking Alpha on this. No, it was bar chart. Uh, you know, most stock picks of the last 3, 4 years been god awful because most stocks haven't done that well. It's been a small number. So like everybody's playing this game like it's a sport, and we're trying to say no, no, no. It's about managing risk, and then when the coast is clear, trying to make a good return. So Oracle, of course, had this disaster, which started here. Okay, it started here when the chart was already fading. Well, then you had this exogenous news event, and I think it looks like it turned yellow a little bit here, but it was still kind of saying, this is still not a healthy pattern. And don't you know, okay, yeah, it would have stunk to miss a 35, 40%, gain that quickly. And then it was over that quickly, and it was done, and it was worse. So to me, it's like, you know, if you look from here to the right, I mean, yeah, it was green during a period where you could make money, and it was red during most of the time where you could lose a lot of money if you were highly positioned. So all we're trying to do, and all I'm trying to do, this is to help you also understand the models, which I'll talk about shortly, is we're trying to make it so that you understand why things are being bought and sold in the models, because not everybody's going to want to copy trade and just hand that over with interactive brokers and pie trade the RIA, and nobody's telling anybody what to do. But we want you to also be able to interpret this, and more I'm looking at like just the deluge of stock pick sites and newsletters out there. It's just off the charts. And a lot of it by people that have no business claiming to be anything close to an expert. And as a result, I feel like what people need, in addition to access and being able to ask questions, of somebody who has done it for a long time, the other thing that people want is they want structure. And the structure comes from the portfolios. You can always break the portfolios down into their component parts. So, like in a case like this, all right, the bigger benefit to somebody of having a Roar score was knowing that if Oracle was one of the stocks in a portfolio that was eligible to be bought, that it would have been held in a decent size here. And for a lot of this stuff, it would have either been de emphasized or it would have been a zero position. Um, that's very different from should I buy or sell Oracle or any other stock. Okay, let me see if there's any other spot in this market where there's anything going on that would be notable. I'm going to pull up, let's see. You know what? Well, I'll do this just to kind of see if it's changed. Let's see where the Roar scores are here. Okay. So remember, it's Tuesday after the close. So tomorrow, sometime during the day on Wednesday, I'm going to look at this for the 10 ETF, the Roar 10 ETF portfolio. And I'm going to, I mean, this is going to dictate to me what the positions are. And then I'm just going to decide if I do any overrides. And I'll walk you through this because, again, I think going forward, you're going to hear me talking a lot about portfolio construction. We're working on a portfolio builder to make it really easy. And the more I keep thinking about what it is that people really want going forward, it's to be able to learn how to create their own portfolio, build it from scratch if they want, borrow off of the builder, the experienced builder, me, um, and then decide how much do I want to do myself, how much do I want to have it piggyback off of what Rob's models look like and what the automated changes are each week or whatever period you like, and then how much is press a button and just have it traded along with my accounts. That to me is kind of where a lot of this is going. World does not need another pick service. Okay, so we know Bill's always 100 because there's not much chance that you're going to have a major loss in that. I mentioned the Qs at 80. Okay, I'm pretty sure that this is, I wouldn't say it's a false signal because it's not saying 100%, but it's saying 80% chance of, the next major move being up. I think everything being so news driven, it's the only reason I would say that. It's a total jump ball at this point. A lot of these things are. Okay. I'm intrigued off day to day, but I'm intrigued by IWC. This is micro cap stock, so smaller than small caps. It's like the bottom half of the small cap universe by size. But again, this and the Dow, a lot of the equity stuff may have gone a little too far. And, and of course, I always think that way. All right. I'm a risk manager. So we'll see. I mean, I could be proven wrong. That's why it says 70% chance of up and 30% chance of down. But, I would not be, I'm not a chaser. And I think this may be reflecting a little bit of the fact that the moves have been so violent so quickly. The NASDAQ is up, I think, 11% in 3 weeks. And NASDAQ's whole freaking index, even its top eight as it is, 11% every 3 weeks. Let's see, if you do that over a year, it's about 200%. So when the NASDAQ's going up at a 200% annualized clip, it doesn't matter what your analysis is. Every technical system is going to say, buy more, buy more. Ours suppresses it a bit. I'm sure if I looked at some of the ones I'm used to, it would say, hey, 100%, only because we can't call it 150% chance of going up. All right. That technicals tend to be that way because it's trend oriented. We built in an automatic brake as these things go up, but I think it's only kicking in partially. See, this is the type of thing that I can explain to you in a live session that I could never write up in an article. It's you have to see it, I think. So anyway, I am admittedly skeptical about this. Maybe the market will love whatever the war news is next, and I say that exactly for that reason. It almost doesn't matter how the war turns out on the ground. It's what the market thinks. And obviously what humanity thinks, but we're talking about the market's part of this. Um, Trying to see if there's anything with bonds. Okay. You can see the bias here. And I think this is, I'm with this, about a 60%, or 60 Roar score in TBF. That's inverse long bond. Okay. Rates are still drifting up. And as a result, Govy is going to be a little less than that. This is not a sharp signal. I'm frankly waiting. Somebody asked me a question today in the soon to be expired chat on Seeking Alpha. All the chat will go to Substack, obviously. And of course, you have our email, so send something there too if you prefer not to chat it out to everybody, whatever. But the question was about the bonds and the bond ladder, and my response basically was, bonds are at some point you're going to see the long bond, I should say the 10-year Treasury, which is in the low to mid fours. You're going to see it go to either 4.5 or 3.5. That's the move I'm looking for from a bond ladder standpoint, and to see if there's a major position to take in either of these. Okay, this is the one. I'll zero in on this in a minute. But PDBC, commodities, 10%, I should say 50% in energy and related. The other 50%, it's got a little gold, a little silver, some ag commodities, kind of broad based, but with an emphasis on energy. Well, this is going to do whatever oil does to some extent, and oil can't make up its mind if you look at the charts. And yeah, this is a legit 40. That's what a 40 is supposed to be, right? It's stretched from a little while ago, but it's in a complete no man's land. Gold similar. I'll have to look at the gold chart, but I think gold may be a little bit pooped. And BTOL is basically a play on buying or owning the lower volatility stocks in the S&P 500 and shorting the high volatility stocks in the S&P 500. Why is it in this portfolio? And again, this is where portfolio construction is really what I'm trying to teach, as opposed to buy this, sell that. Because we're not talking about how much, we're not talking about for how long, we know nothing about your objectives. Remember, I'm a former advisor and fiduciary brain, thinking about all this stuff to try to figure out a way to translate it. And that's why I love having this in here, because you're going to have markets where the Qs are going to rally hard. And when they do, this is going to somewhat offset it because it's probably short that stuff and it's long the other stuff. If DIA, and we've seen a lot of markets where the Qs go up and Dow or the average stock maybe will go down or just not keep up. This is sort of the equalizer. This is so that I don't have to go all the way in with like an SH or a PSQ or a DOG. Those are the three ETFs for the major stock indexes that are inverse. I had RWM, inverse small caps, in here at one point, but I decided this was a better hedge. So if you want to think of it this way, equity, equity, equity. This is like the little equity basket here. Everything else is bonds and commodities, except BTOL, as described. That's why on a day like today, it would be up. And VIXI, which had a muted return today, but this is the closest thing you get in an ETF form to a put option on the S&P 500. So Before I go to the portfolios, let me just go back here. Yeah, because I mean, this has been a wild, wild ride for this thing. Remember, oil driven. Okay. And yeah, see, this is a little more of what I would expect from the cues. That's why I have an inquiry into the programmers. Okay, you know, if I look at this chart and it's helping me saying, okay, there's such a thing as I think my kids used to have the expression, not bad. When something really good happened, they said, not bad. Well, this is what I would call not bad. Yellow is not bad. Okay, it's good and it's not inherently dangerous or immediately dangerous, not bad. That's yellow. And you can make a lot of money with not bad when it trends like that. Uh, you know, it it was also not bad all the way through here. However, there's been plenty of price volatility. We probably just can't see it unless we come in here. Okay. And again, this is smooth because it's not all energy. Matter of fact, let me pull up here. I just wrote about USO. And let's look at year to date. Let's see. Surprise is not more. I guess I'm okay. So we had the huge rise in oil. Okay. Again, it's signaled here, but this is Roar kicking in. And again, this is not just Roar. This is just how to manage through the cycle of your portfolio or the positions in the portfolio. Okay. This is, so it gives you the green. Something good was happening here. It wasn't immediately apparent, but it only took about a week. And then boom. But this doesn't mean sell it. It just means it's neither strong nor weak. It's in a transition. But if it's transitioning on the way up, just fine. Price action matters too. It's not just blindly following the signals. And this continued to work. And of course, you had this major, decline. That's a 10% decline in USO, like immediately. No technical system is going to guard against that. The only way you can guard against that is by saying, hey, you know what? When something's gone up by that much, you should cut it back automatically. That's just called rebalancing. Um, if I, back in the day, if I had a 5% position in a stock, 5% of the portfolio. And all of a sudden it's like, boy, it's done so well versus the others. It's 7%. If I don't cut that back to 5% and it crashes on earnings or something, shame on me, you know, and that's what a model portfolio does. It gives you a place to come back to, even if the model positions are changing. Okay. So right now, this is telling me, frankly, what I would hope it would. It's undecided. It's not saying that oil is pardon the expression in the tank, and it wasn't really saying, hey, this one's over. Okay, it was going to be volatile because it's oil, but especially now. But it's kind of like, hey, hang in there. Maybe it's not done yet. And let me go over to here because I was just researching this for an article. When you look at it in the stock price chart, okay, I mean that's just wild, right? I mean, this is the time. This is what we just saw. Okay, 20-day moving average, 50-day moving average, crawling higher, right around here somewhere. It says, it looks like there's a little lift to this here, the type of lift that we recognize as bullish. So Roar goes green. I'm showing you because, you know, years and years of looking at stuff like this is what we are translating into Roar, which is why it's not perfect, but it's pretty darn good. And now, once you get to here and it's spiking up like this, well, I don't know about you, I would, I'm happy to accumulate something when it's here. Once it gets to here, I might buy call options. I'll do something, but what I'm not going to do probably is sit still because I'm not going to take a chance to give back the loss. I don't care how high it goes because I'm managing risk. Uh, and I'm going to make sure that I don't get uh, whipsaw it either. Bringing the position back down, and that's what those that RUR 10 ETF model and the other models are doing with every position, and saying, hey, do I want a minimal amount, a standard amount, or an above average amount? And it can change quickly as markets do. So then you get to the top here, and I'm sure there were plenty of people on the street saying, "Oh, yeah, yeah, USO is going to go to 200 within a month." Well, maybe it will, but that's stretched to me. Then it looks like it's starting to roll over, but look at this, okay? Every once in a while, Dana will hear me probably from across the house. I think I got this from my late father. All of a sudden, I'll just do like a whoa, like like I see something going on, okay? And what I saw was all of a sudden these things that looked like they were done. Oh, the oil thing is over. Nah, not so fast. In fact, I'll show you here. So I probably have to go down to 2 hour chart. Okay. This is a much shorter time frame, but you can see it's already, if this were a daily chart, it would be getting very close to a buy range. PPO is crossing up, getting close to zero. That's a good sign. A little bit more from here, not out of the woods yet, still in a downtrend, but it's getting there. Okay. The 50, well, the 50 period of the 2 hours, so 100 hours, I guess, is is showing some lift, and these are shorter term signals, but you can see it's you might call this counter trend, and so that's why I mean the reason if you're ever thinking, gee, Rob's not bad at seeing things maybe a few days to a week before big things happen. I'm not Nostradamus. I'm probably Nostradamus, not Nostradamus. But this is one time frame. There are so many different time frames that I look at, and I kind of go across the board the other way and say, okay, if this is happening in the short term and the dominoes keep falling, that's what makes a move. That's probably a whole course in itself. Anyway, so here we are with this. I'm going to stop to answer your questions. Then I'm going to run through some of the portfolios, probably just a couple of them here. And let me also see if I can pull this up from yesterday from ETF yourself. Okay, let me see. Hmm, Yesterday. There we go. Okay, I'll come back. Oops. I will come back to this shortly. Let's take a look at some questions. Good. Glad there are a lot of them. Okay, let's see. A lot of questions. All right, let me see. Let me see. Good. It looks like Dan has been doing some customer service. Okay. Automated. Okay. So I think this was one of the questions. And let me go to the Roar Pie trade. I'll just pull it up here. It should do. Okay. So I think the question was about this. If I'm wrong, stop me before I go down the wrong path. Okay. So this is what I put in the moment that I'm writing the weekly on Tuesdays. I pull up this snapshot. Okay. By the way, you don't see this the way I do, but these are not recommendations. One of my requests is, like the current allocations to the model. Yes, they're not none of this is recommended. The old fiduciary, difference between personalized advice and not. So this is what I pull up, and this is a snapshot. And frankly, that's another part of this. Maybe we shouldn't have these things updating intraday. Great for traders, maybe confusing for investors. Yeah, and for true risk managers. So again, this is where the more collective feedback we get from the early adopters, the better off we're going to be. So, um, you know, we have, and this is the same place it was last week. So it was kind of a net nothing. All right, the Qs were 25, Dows were 27. And where is, yeah, IWC. So this is signaling, oh, your equity exposure between these three should be 61%. Seemed a little high. I could live with it. I'm trying to follow the automated model, but then VIXI was at 0. And that was a little bit of a kink in the system, which is why I'm still kind of double checking this thing for at least for a little while. And let me see. Yeah. So these are the automated allocators. So the question is, why is this different from what you would get if you were copy trading at PyTrade or this account? Or if I were putting it out to you, I don't know, but whatever, you're just looking at the actual model, like we used to do in the spreadsheet, okay? Because the model is a little bit less. It's 25, 25, and 3, okay? Um, and a little bit more in cash. The rest are, for the most part, the same. Uh, and that's because what you're looking at here is the automated, updated at any moment in time version. Because what we figure is that people are going to go into this site, they're going to see this portfolio, and they're not going to say, oh, what are the model positions? Because the model positions, let's say at this point in the week, were set a week ago. I want to know if I'm doing this myself, if I'm a do-it-yourselfer and I'm using this, what is it telling me is the portfolio allocation right this second? And then now you're the portfolio manager and you say, okay, I'm going to come back to this thing every Tuesday night, or I'm going to come back to this thing every other Friday, or on the first day of the month. And this is giving you a snapshot of where it is. It's almost like saying, like, don't show me model positions, show me what the actual portfolio looks like. It's almost like recalibrating, because these things will, I mean, the Roar scores will change intraday, and there's a little bit of rounding here because, there's a possibility, if a lot of these things are really bullish, that it could say, oh, you have to allocate 120% to this. Well, you can't do that. So you have to shave them down. That's why you get some oddball percentages in here. But look, the big picture here is this is not identical. I've been trying to express that in the weekly. This is a snapshot of an automated calculation of this model. The one step that I will take tomorrow, sometime during the day, usually in the morning, not always. On Wednesdays, I'm going to pull this up just like I did here. And me, Mr. Longtime Portfolio Guy, is going to look at these, and I'm going to do one final check. I'm going to look at all the charts. I'm going to come back to here. I'm going to look at where they've been, and I'm going to basically do a double check and say, you're telling me 28. Okay, maybe I can live with that. And I was, like I said, I was fine with these, but VIXI should never, and that's what I said to the programmers, VIXI should never be 0. In fact, it's not supposed to be. It's supposed to at least have a 1% position. Why? Because if we wake up tomorrow morning or any morning and, we really have destroyed a civilization, okay, quote unquote, and the markets react negatively to that, is no way I'm going to be caught flat-footed. I will sacrifice 1%, 2% of my portfolio, and I have always been this way, Doesn't mean you have to be, but this is always how I've managed money. 1 to 2% of this portfolio at a minimum needs to be in something that, and here is VIXI, in something that, where are you? Let's see, where is that rapid move I'm looking for? You know what? Okay, good enough. Let's see, how much of a move is it? 33 to 30. Yeah, okay. That's 15% in like a day, 2 days. 15% in 2 days. And that was on top of what? 26 to 35. So that's 35%. Okay. All in a month's time. Because we're not using put options here, it's all ETF. And those who've been with us for a while, will know the history. Okay. Options are great, but they can get unwieldy at times. We're at the point with this thing where like I insist in my risk managed portfolios, at least the ones that have this many securities in it, I insist on having some type of avoid big loss position beyond what BTOL can do for me, beyond what bonds can do for me. The only exception would be in this one. I use this as a opportunity to, okay. So look, SPY's at 70. Okay, fine. I mean, look, it works out over time. Okay. But, this is the only place to hide, but at least it's, we have that buffer. That's why this one's always going to have a little bit higher, uh, uh, um, let's say, crash downside. And that's why I built hedged equity. It's the same thing, but with a VIXI. And even though the VIXI right now is at 1%, hey, if the market really does a number tomorrow, let's say, this thing goes up 20 or 30, 40%, it could in a day, it's going to make up for a lot of this. I insist on having that crash protection, or a crash helmet, as we used to call it, in the portfolio at all times. If it's not this, then it's something else in terms of cash or an inverse or something, because I am not going down with the ship. So you will find that every one of these has something, even the more aggressive ones. I mean, this is the most aggressive. Okay. Hope you like the name. It's very simple also. And this is why, going back to the simplicity argument, now I'll get to the other questions. This is triple S&P. Triple. It's not XL, it's like triple, 3XL. Okay. I wear a 2XL most of the time. All right. TZA, also a triple, but it's not, it would make no sense to have S&P and negative S&P. It would just offset each other most of the time. This is 3 times long S&P 500. Does it say it here? Yeah. 3 times long S&P 500, bull, and 3 times short small caps. Why? Because it is trying to, you'll hear, I put it in the description, okay? Trying to exploit what the model manager, me, believes as a secular advantage of large cap stocks over small cap stocks. It's all because of the indexes and how they're created. How much more money there is benchmarked or in index funds to the S&P than there is to the Russell 2000. It's not even close. So what we did here is we said, okay, it's going to lead with this. It's got this. But in times where this is really starting to look ugly, let's always at least have a little bit of this. But what would happen if the market really started to roll over and die? Well, it would reduce the position in the triple long SPYs. It would increase the position in the triple short small cap, because what usually happens is when they all go down, large cap goes down and small cap goes down more. Let's say for argument that there were no cash and this was 50-50. Guess what, fans? There's a good chance that this going down will be less than this goes up. So you can actually make money in a down market, which is the point. Um, and that's and look how simple this is. I'm probably going to just start focusing on simplicity. And look, I mean, I'm going to take the pandemic period out, which is easy to do by doing this. Okay, and it's about the same. Um, Again, I'm not saying this is something that people would be, throwing all their money in. But when you think about the people that have, and this again, this is portfolio design and construction, and why I want to make sure that if there's a lot of people who want to use Roar scores as a stock picking, ETF picking system, have at it, but know that that's sort of the second best thing about it for everything we've talked about here. But if I look at this and I say, okay, let's see. If I'm trying to be an aggressive investor and I say, well, the SP 500 is okay. I want S&P returns, but I really would like to, kick its butt. Okay. If I'm only taking on a little bit of extra risk in terms of how bad it could get, and similarly, my standard deviation here, 22. So yeah, whatever. I'm taking 30% more risk. Okay. Is the risk worth it? Well, if I think that the bull market's going to continue ad nauseum or, ad infinitum, is that right? Okay. Well, I like the idea that in the last 5 years in a bull market for SPY, its bull market is 12% a year, but mine is more than that. That's a big difference. And I've taken 10% more risk than SPY. That's beta. That's the beta 109. And those of you who know us from Seeking Alpha, Alpha sought, Alpha found. How about that? Boom, boom. Okay. So this is the laboratory, if you will, that I used for clients for years, used for myself. I'm always experimenting. I welcome ideas. I think Jim, some of the others have actually given me some ideas. And that's the other part of this that we think is really cool. You can go in and say, all right, I learned something talking to Rob. I'm going to go build my own. And it tells you exactly how to do it. So to me, like we're not talking about, this is not a product or a service we're talking about. This is how to be a do it yourself investor in 2026 and beyond when the markets, frankly, and one more thing here, and then back to the questions, and then we'll finish. If I go back to the portfolios, okay. Um, if the simplest portfolio I could ever think of for a conservative investor, which is what this is, okay, can do this much better uh, in this type of environment, we're going to try to run these against the S&P too. Actually, I think that's what I did yesterday in this thing, right? Yeah. Um, okay. I mean, I was going to use the Chandler Bing from Friends line. Okay. Could it be any simpler for those of you who are fans? Very low volatility expected. Return 8.3. Is that S&P? No, it's not. It's not trying to be. Okay. But it's taking half the risk. So it's getting you 63 or has gotten you 64% of the ups and 49 percent of the volatility on the way down. And that's the simplest because it has no other way to hedge. Okay. Hedged equity adds a little to both sides, but the 10 ETF, and this is the best part about it, okay, performance wise, these guys end up in a similar spot. But it's those nook and cranny times like now. When I look at my 10 ETF, my Roar 10 ETF account, and I say, geez, this thing, I mean, it's not up 10 days out of 10, but probably 8 days out of 10. And the other 2 days is pretty close. it's doing exactly what it's supposed to be doing. And what that says to me is, with a little bit of research and portfolio modeling and some risk management, that's the formula in a nutshell. With that, you can control your destiny, financially speaking, a lot more than you normally could. And once you've got that in place, for me, it's the bond ladder and it's this, and it's a smattering of this stuff. I like this one especially. Um, but whichever ones you take a liking to, between, and again, the bottom ladder is just my thing, it's not for everybody, but you know, this, if you can operate on the idea that this is like your core approach, now you want to go do stock picking, you want to buy options, you want to speculate, you want to chase the FOMO, you want to see how you can get into the next hot IPO. Go for it. Go for it. Because you have done the equivalent, if you will, of avoid big loss from doing a lot of this. And but there's different degrees, right? There's the max drawdown 8%, and again, these are past and back tested, okay? But I mean, they range from 8 to 39, okay? I didn't actually look at this yesterday, but yeah, and the annualized returns, okay, since this decade started, 8 to 18.8. Going forward, we might be in an environment where some of these do the best and the return might be 6% because a lot of these are close to zero or slightly negative because the market's down 20% and these are just holding in better. So, but my point is there is a spectrum here. We're even adding more. And so to me, I just keep going back to like portfolio construction. Learn to build a portfolio, and you can always do the stock picking or the ETF picking next because there is so much correlation I cannot even tell you, and I keep winning the argument with myself to say, oh, is this really special? Should I own this new ETF that invests in whatever? Or is it just a different name for the same darn thing that's already out there? Okay. So anyway, I know we've covered a lot of different things here, but they all go together. Okay, let's see. Finish up with the questions. A lot of conversation as well as questions, which is very cool. Okay. All right, all right. Looking for the questions. Okay, like the subsector details to see possible call and put ideas. Oh, great idea. Great idea. Yes, I'm sure I thought of that at some point, but you reminded me of it. Yeah, yeah. You know what? These are, frankly, I mean, I'd say they're at least as good for that. Remember, volatility has to be low. You don't want to be doing this when buying call and put options when the vol is spiking. Okay, we got a little reprieve here. Okay, I know I upped some of my SPY call and put positions in terms of size because the volatility was low, and so you can get more bang for the buck. Let me see here. This thing keeps skipping around on me. Okay. Let me see. Show the sector with the ability to click to expand might look cleaner. Let me just see here. It's funny. One of the ideas, let's just go to a different one. Okay, discretionary. The idea would be that if you click on discretionary, you can see all this. Okay. By the way, too much or just fine, doesn't matter. I can ignore it if I want to. Because this was really cool to me at the beginning, but then it starts to become paralysis by analysis. That's why we also, I mean, this was a brilliant thing where you can click on here and basically say, hey, if I just wanted to own XLY and cash, and I'll give you a quick example here, but I always want to own between 50 and 100% in it. If I did that instead of a buy and hold, it didn't make too much of a difference in this case. Okay. In fact, it might even hurt you when something like this goes up most of the time. But I'll bet if we look at this, if we looked at this over a period of time for something that didn't do that well, like here, it adds alpha. And you can do this for any security. You can create, and that's basically similar to what you were saying, Benny, about the call option or put option on something. I look at this as, do I want a full position, a partial position, a very small position, or no position? And that to me is the best way to think of Roar score, which is why the best models are the ones that force me to own everything all the time. I just de-emphasize and emphasize as I go. Okay, let me move on to the others and have us finish up here. Let's see. Okay. Yep, subsector valuable. Not certain we need all, yeah, all 75 to support each subsector. So, to complete my thought from before, the idea was if XLY is the main one we're looking at, the question you would have is, okay, what about it takes a little while. If it's XLY, we'd like to be able to have a button here that says, okay, you can click on XLY and it's going to give you, I don't think we do all the holdings. We definitely do top 10. Uh, Most of these things are concentrated anyway. Show me the top 10 holdings and show me their ROAR scores. However, just so you know, there's another way to do that. So let's take XLY, stick with it. Constituents. Okay. So if you like XLY, unless you're a real deep stock picker, okay, I mean, the top 10 are 71% of this. And roughly speaking, yeah, here's the top 10. You could take these 10 tickers, you could create a watch list, and you can start putting the tickers in, and you can create one of your watch lists. I did this. My second one is sectors. I don't know. These are probably just experimenting with stuff. I don't think I've even filled them out yet. But that's the idea. I mean, you can't have an endless number of these at this point. I think it's a limitation, but you certainly can. Um, uh, you can put a watch list and then instantly you can see these all the time. So at least for now, that may not be the full solution, but it's in the direction. Okay, let's see. Um, mm, mm, mm. All right, let me see. Yes. I know who the info hogs are. Wink, wink, nudge, nudge. I'm one of them for sure. But still, it's not so much about the information. There's information and then there's redundancy. Here, let me find this here. If I go back to that market map, okay, or at least the abbreviated one, what I'm looking at right now, I'm actually doing a little AI-based testing to say how many of these 75 are really different from each other, even down to things like, and I don't think it's the case, but do REITs and utilities kind of move together because they're both kind of interest rate sensitive? Or do REITs move too much like government bonds so that if you want REITs and are just more volatile versions of government bonds, maybe you just buy a 2x government bond. You just have to follow government bonds. You know what I mean? Fewer things to follow closely and then get to know them well. That to me, I think, is where a lot of do-it-yourself investing is going. All right, somebody asked, let's see, yeah, Teresa, Roar Score Red. Roar Score Red, I think you're probably talking for SPY or one of the major indexes. I'll assume that.
No, it was actually when you were going over Oracle.
Oh, Oracle. Sorry. Yep. Okay. Let's see. Aha. Why? Oh, why was the Roar Score red for so long? Well, because this is the price. Remember, the color is just the zone of the red of the Roar Score. So Roar was 30 or below, just about every day. Oh yeah, every day from 328. It looks like very brief here, but basically for the most part, from 328 to somewhere around 200. Okay. So the entire 40% of the way down, what it's basically saying is, and this to me, you want to you want a snapshot of the next bear market. Those of you who have been through a few, I think I've been through six or seven. This is what happens in a bear market. Buy the dip. Buy the buy the but no, I can't even complete margin call. Okay, I sound like Kramer. All right,
Well,
this is buy the dip.
I meant more like it. So it goes up a lot in the middle of September, but then it stays up. And so why did it? And then it even goes up a little more the like
Yes,
middle of October. So
yes.
why did you still have it as a negative pattern?
Well, I didn't
Just
because remember,
taking
it's
it like
yeah, it's
if the world ended like October 20th, why was it still red around then?
well, okay, remember, red is telling you there's high risk, and there was still very much high risk. If you're talking about, I don't know if you're talking about here or here. Remember,
Yeah.
the price here is in the 300s, and what it's saying is uh, there is still a bias. It's still high risk. Remember, high risk also means a lot of time high reward, and that's what you saw here. Okay, think of roar more as, is this about to get volatile? And if it's going to get volatile and it is red, it's saying it's more likely to go down a lot. That's the first possibility. The second possibility is it's going to go up a lot, smaller percentage, and it's least likely to sit still. Reds don't often, you don't see a lot of flatline reds because the price chart is, go back to this one. I'll use Oracle because that's what we're talking about. Obviously, there's a lot more to it than that, but here, okay, this is the price chart of Oracle around that time. And I mean, if I have a big three, it's uh, to look for danger, PPO rolling over from a high level, check. Okay. This happened in a couple of periods here. Remember, this is right after it went up 35% in a day. So it's a little bit of an oddball case, but this is starting to roll over, you know, false alarm, but then it fell through. And by the way, you know what you see here. Those of you who are not moving average people, it might be a little confusing, but hey, what's the difference between this and this? 20-day moving average in red is falling. 50-day moving average in green is still not falling. Here, they're both falling. And so is this and crossing over. Boom, boom, boom. Okay. Roar is not built on that specifically, but I would say that's sort of in the direction of the type of things that it looks at, calculates on the fly constantly. I'll never know how they do this other than, but that's doing the best job it can of saying if Rob is reading this chart around this time, he is thinking dead red, this thing's going down. And and it never really got to the point, like, because we are so used to buy the dip, and you can see it in the chart, like, oh, if you were really a gunslinger, or matter of fact, back when I was doing a lot of collar work with a group, this might have been a collar. Because, well, if it drops below, here, let's say, I'm going to be out anyway because I'm going to have a put option, but it could go back to here. This gain versus this little loss, I can collar that and I've got a good chance. I would not buy this outright. I might buy a teeny position, or I might buy a two times leveraged Oracle ETF in fact, I think I did that very recently, just in my trading account, little position. I bought a 2x Oracle ETF when I saw this little signal. It's a dangerous signal because it's a dangerous market. But I put a little bit of money in it. Okay, fine, I'll put in half as much and I'll do it. But that's trading. That's trading. Okay. So hopefully does that help you understand how the chart
Yeah.
and Rohr's interpretation of the chart, this is just the next step.
Yeah. So you're using the PPO at, like in as a, I don't know what fraction of your ROAR score. So it's not just the stock price, but it's the
Oh,
PPO.
no,
You're
no, no, no,
combining.
no. No, I will tell you, Roar has a lot of things in it. And obviously it's kind of a secret sauce, for legal reasons as much as anything else. But I can tell you this. Okay, I'm happy to talk about this. In fact, I've been meaning to write an article about this in multiple places. To me, if they if you're on a desert island, right, and you can only take whatever one book or one food with you, okay. If I was on a desert island and they said, as an investor, and they said you can one indicator, it would not be the Fed funds rate, okay, it would not be S&P earnings, and it wouldn't be, I don't know what Kramer or anybody else is saying on TV. That would not be my one indicator. My one indicator would be the 20-day moving average for any security. It is not perfect, but it is right more often than just about anything I've seen. And I'm actually in the process of doing a study to try to show that. That is a fraction of Roar, but I can tell you that it started by looking at the 20-day moving average and saying, okay, that and a bunch of friends and a bunch of rules about when, because look, 20-day moving average, it's great when it's up, but what about when it's up this much? The more it starts to go up, the more dangerous it gets. It doesn't mean it's going to get dangerous. See, I mean, look at right here. Matter of fact, no, you could, yeah, look at right here. Okay. That's a long way up in a short amount of time. So, uh, most technical systems are going to say long and strong, just keep buying. Okay. Or hold it if you own it. I say, you know, money doesn't come that easy. And so if I owned a position of whatever, if I owned $100 in it here, I might cut it back to $50 here. I might cut it back to $25 here. I probably wouldn't sell it here because maybe it's not a full signal. Then you boost up to here. Well, guess what? I'm probably already selling it back down a little bit. It's position sizing. That's a very quick and dirty explanation of position sizing. And if you do that across all positions at all times, and the Dow is the best one, I haven't really talked about this much yet because it's been such a iffy stock market. But when the stock market is a little more reasonable, we'll start looking at this one a lot in these sessions. This is basically a Roar infused opinion on all 30 Dow stocks anytime. Go in here 24/7 and it will give you what those are. It's more, Roar's more optimistic about Apple, Boeing at this point, not so much CVX. Maybe that will change if oil spikes again. Okay, CRM, which of course has been in the dumper. All right, and all the way through. And to me, it's not the individual stock scores, it is the collective. It is the fact that this thing earlier in the year couldn't find anything to buy. And so when the market really started hitting the skids in here, okay, it was falling because it forces it to own all of them at all times. But for a lot of them, it could just own 1%. So if it owns 1% of all 30 stocks, that's 30% long and 70% in cash. That's a lot better than, being thrown to the wolves. And it's all because, like I've tried to make the theme today, uh, the Roar score is solid at the individual security level, but it's when you put the constraints of a portfolio manager or constructor around it, and you start picking and choosing. In my old business, the advisory rule, they used to call this optimizing the allocation. I wouldn't say it's optimizing, but it is using the Roar scores for all securities that are in the tank, that are in the portfolio, playing them off of each other and saying, okay, this is the best way to allocate it. Frankly, this is why I think if we ever got this in front of some advisory firms, brokerage firms, institutions, etc., trust companies, I mean, anybody who manages large amounts of money, and we are itching to do that. So if you know anybody, I mean, I got plenty of connections, but we're looking this what I just described to you, overlaying that to what any individual investor or bigger investor, family office, whatever, what anybody does, overlay it onto what they're already doing. And I think it makes it better. And that's really what we created.
Rob,
Yes, sir.
Rob, can you go back to that page you were just on, the
Yes,
Dow
sir.
allocations?
Yeah. Okay.
No, the Dow
Oh, I'm
allocation.
sorry. I thought I did.
Yeah.
Yeah, yeah. Oh, right, because I clicked. Oh, that's right. It's down here. Still remembering where everything is, Jim. Go ahead.
Now, I remember the last time I checked, which might have been last week or so, a lot of those were zeros.
These were zeros.
Yes.
Then
So,
yeah, yep.
but the bigger question is, how do we know when there's a change? And the suggestion would be
Mm-hmm.
right next to recommended allocations, the wording there, you could
You
put
mean a change in the model?
right,
In the model position, because you can always see the changes in the roar scores here.
right.
Uh-huh.
But maybe you could put in parentheses right next to recommended allocations there, a date stamp or a time stamp, something like that, something that says as of
Ah,
April
yes.
20th, something
So
along those lines.
so you're heading right toward the type of feedback that we want, because there's a world where we say, we'll show you the scores, but a lot of this stuff is going to be riffraff. We can put like, I because I was granular guy before, like, oh, give me a 5 day. Originally I think they had like 20, 40, and 6. No, I want 5 and 10. Okay. And I realized, too much information. So we may have this, last week, last month, 3 months ago, just so you can see the general trend. And of course, you can graph the trend. But where I think it might, piggybacking off of what you said, where this might be um, very helpful is to say, okay, don't constantly update these. Do it as either a weekly or couple times a week or something. And then one click away is the history. So you can
Yes,
start to see
perfect.
how these
Yep.
things, right? But again, I'd love to hear on here who likes that idea, because what I just said, if you didn't realize, is is I am trying to de-emphasize let me look up a stock, because we tried. Like, they report at Pie Trade, they report the numbers to us as like this many people are going on, this is what they're looking at. Oh, people like the watch list, fine. I said to them, tell me in 90 days if they still like the watch list, because it's a great toy, and then you lose interest. To me, what we don't lose interest in is something that is going to teach us a method that we didn't know before. I know a lot of you are learning, and you're learning quickly, as I expected. But like, to me, it's like, what is our purpose on Earth with Roar Pie Trade and the writing around it, is to teach people that you can build your own portfolio home, if you will. Uh, uh, and it's not as simple as find good stocks to buy. It has to do with what we were just talking about. The Roar score is not to say buy or sell. The Roar score is to say, I know what I want to buy or what I want to own if I already own it. Should I own a lot, a little, very little, or maybe none at all? And like you said, yes, thank you for reminding me. I could not remember, frankly, because we create a lot of these pretty quick. I've been dreaming about having something like this for a long time, and it came out even better than I thought. So yes, there is a condition. I think we have it. I'm trying to remember offhand, but it would almost be worth, let's say, being a little more transparent with this because I can tell you that, and let me show you where it is. I'll show you the mechanism behind it. Let's see here. Create a portfolio. And let's see. Is this the one? No. Yeah, I'll do it with a single ticker. It'll be easier. Or here. Okay. This goes for anything, but I'll show you using SPY. Oops, I have two of them in here. How did that happen? Okay, let me try to start over. Uh-oh. All right. I can probably take it out here. No. Here. Okay. All right. So SPY is my only security here. But you see this here? This is kind of this would basically say if your ROAR score is less than 40, you're going to have a smaller position. And this model, I don't think these are the numbers, but whatever. They put in some just whatever numbers to fill the spots, okay? Say when I'm bearish on the market, I want 20% in SPY because the rest is going into bill. When I'm neutral, all right, I'll have 60 in. And when I'm bullish, I want all 100 in because bill's the only other one. You can experiment with this all you want, okay? And again, I'm looking here at what malfunctioned. I think this has to do with because I put the Q's in there before. I think it may have screwed it up. But anyway, but the idea is, oh no, okay, yeah, it's always going to allocate 1% to bill. So basically, right now, the SPY ROAR score is on the bullish side, at least for now. Okay, and so what it does is it says, all right, you only have one security, but you got three conditions. 100% in SPY, rest in bill, 60% in SPY, rest in bill, 20% in SPY, the rest in bill. You can make these, and this is the beauty of it, okay? And why I think I'd rather have people focusing on learning to build, rotate portfolios. I mean, I can teach technical analysis all day long, but this is why using the ROAR scores for, should I buy this or sell this? It's secondary use to me, okay? On the other hand, if you wanted to be more aggressive, oh, maybe you would do something like this. Okay, now it's, you know what? I never want to have less than 60, but I'm giving myself the old buffer. Okay, those of you who've been with us for a while will remember we used to have the regular SPY bill conservative and we had the moderate where it said take 50% always in SPY, minimum 50 in SPY. So that's kind of like saying, all right, I'm going to have a minimum of 50 in SPY, and it's either going to be 50, 75, or 100. And if you go and run that back and you run your metrics here, okay, it's going to give you different numbers, because you're giving it more room. So this to me is the part that if I could teach, starting with you folks as the inner circle, if I can take you and I can teach more people from there, I mean, not only would it be make everybody a better investor, I'm convinced, but it would be the best deal going for $1,000, except you guys are getting it for 600. It's going to go up to 1,000 probably soon enough, maybe more. We'll see. Okay. So anyway, Jim, that's I know I turned some of these questions into dissertations, but it's because we are covering all the things that allow us to go from here we are in tough markets. If they really, really, really get tough, we're going to be happy that we have helped engineer this system to be, even more alpha producing than I think it already is. Plus, we record these, and a lot of these are going to end up being like tutorial things pretty soon. Okay, let's see. Any other questions? Yeah, Rorsco Red. Well, when is VTOL the strongest? I'm so yeah. Just answer a few here before we finish up, and then I'll take any other live questions. When is BTOL the strongest in a volatile environment? No, BTOL is the strongest when BTOL is basically saying I am bullish on a broader market. Okay, so when the rest of the market is partaking and things are a little more even. By the way, it's been a long time since that has happened. Okay. You can see BTOL has had a really rough go of it for a long time. Not its fault. It's that for the long, except for some brief periods here. Okay. What this basically, if you look back, you'll probably see that MAG 7 was not doing too well here. And that generally speaking, the smaller large cap stocks and the more sheepish sectors, when consumer staples and utilities and REITs and maybe industrials, healthcare, when those are leading, that tilts BTOL to being stronger. It's when tech is dominating and when large cap tech is dominating, you will see this. And that's why it's a good hedge. And more importantly, why being able to fluctuate. See, now looking at this chart now, would you say, oh, I'd never owned BTOL? Look at this. It went from 24 here. Let's go back a little bit shorter. Okay. In the last 5 years, this thing has not made money in this market. Why would I ever want to own this? Well, you might choose, as I do in ROR 10 ETF, to always own at least a little bit of it, but you're going to own a lot less, okay, when it's going through these MAG 7 dominated markets. But there's going to come a time when either because the whole market is doing poorly. I'm looking here. Let me try to find last year here. Okay. Look at what BTOL did when the tariff thing started hitting a little over a year ago. It went from 18 to 21. Okay. Not a major thing, but look, 15% up when the market's falling by 15 or 20%. And being able to own maybe 10, 12, 15% in that security, that and VIXI offset a lot of pain in the Qs and the DIA. So again, putting it all together, this is why having this set of securities, whatever set they are, anywhere from 2 ETFs to 30 stocks are the varieties that we offer. And we can build as many as we want. We can build one with 100 stocks if we wanted to, but it would be a little awkward. But that's the idea. It's putting these ingredients in to create great portfolios in the same way that why are ETFs popular? Probably for the wrong reason. ETFs have gotten popular because, well, the equity market's going up. So you put your money in an equity ETF and a lot of them go up. But really, ETFs are doing the automated portfolio construction for you. I'm old enough to remember when if you wanted to own the Dow 30, you had to buy 30 stocks. Now you buy DIA and you're in. Or if you want to buy eDow, you get equal weighted across the board. So ETFs have done that. I have actually heard people accidentally refer to what we're doing here as creating your own personalized ETF. The only difference is you are defining the rules based on high ROR score, lower risk, low ROR score, higher risk, lower position, and then somewhere in the middle. we decided to go with three different levels because we didn't want to make it more complicated than that. But that's it. This is like creating your own ETF. In fact, I guess I'll tell the marketing people when we have them. All right. But when you think of it that way, this is constructing your own baskets, but way beyond what is out there from what I've seen. Okay. Any more questions? Okay, we covered subsectors, we covered BTOL. Why use the DEO, the exponential moving average? No, the DEMA instead of the EMA. Let me see. I am not sure, Don. Don's still here? Yeah. I'm not sure what you mean by the DEMA, DEMA versus the regular EMA. I use the exponential moving average instead of the simple moving average. Because I want to have a little more emphasis on the near term. That's the difference. Yeah, the irregular moving average just says, oh, it's 20 days, average the 20 days. An exponential moving average says, of those 20 days, I'm going to emphasize the last several days more than I am 20 days ago because it's becoming ancient history already. That's kind of the explanation. But yeah, follow up with that if you like, because I'm not sure what the DEMA is. Okay, so let's see. Do the performance metrics on Roar Pie Trade reflect the portfolio results with your audibles, or are they simply portfolio driven? Good question. Okay, so on Roar.pie Trade, when you see any of those models, this is without human hands. Okay. So, in fact, believe you me, okay, what I keep telling our partners at Pie Trade is that I am looking to this very carefully and I am tracking Robo Rob, which is what you're looking at, versus Human Rob. And yes, I do want to get that little change in there. I don't want the VIXie to be zero and whatever. But those are really little tweaks. And I've said to them, any week now, I'm going to say hands off. And this is Robo. This is completely is all we we created the mechanism, the rules. We said here are I'll be writing this up pretty soon, kind of because this is the same pattern, the same path anybody would go through. First step, figure out what you want to go on the portfolio based on what you want it to do. Second step, decide you want them to be is do you want it to be a permanent portfolio where everything is owned at least a little bit all the time? Then which levels? What are your levels? Okay, all right, QQQ can't be more than X, can't be less than X. VIXI is going to be much smaller. I don't think it can go more than about 5-6%. Okay, because it's so much more volatile than this. That's the rules. That's what we're going to be putting together as a guide, a step-by-step guide. And knowing these guys, they will be able to program it in. So it literally just says, it asks you questions, you put the questions in, and it builds the portfolio. Right now, you have that step-by-step thing on the side here, but that's what we're really excited about. So yeah, this is all automated, and I'm like, I, can, can I do much better than this? And that's when we decided, okay, we need to bring this out sooner rather than later. Roar started as the Roar score and the whole thing, but I always felt like my best skill to pass on was portfolio construction. And when you look at the fact that, I mean, this is like the pride and joy. Okay, I mean, I'm going to try to convince myself maybe one day I don't need bonds. I'm not quite there yet because I'm very conservative. But I mean, who knows? Okay, but this is since the pandemic. If there's any chance in heck of analyzing even close to 9% in an environment where a 40-60 or moderate risk portfolio was less than half of that, and having an 8% max drawdown. I know I didn't really go over this, but um, if you look at these numbers, and you were to, you could ask AI, you could look it up. I'll probably put some stuff out. Okay. Try finding something that has an annualized return in the high single digits and a standard deviation that isn't like 15 to 20. Standard deviation, how variable the returns are. Okay. So again, avoid big loss, make as much as you can, and we'll be. So we're gonna. I put this out because it was a placeholder because they're they're gonna have a lot of this type of analytics and stuff on the site, but we can only do so much at once. That's why I said we're gonna look back. I think, and as long as they continue to do what they've been doing, and again, there's no human to screw it up. Okay, stop myself from cursing there. Um, you know, there's nobody, nobody that can mess it up. All right. Yeah, I'm sitting here and help me with this, folks. It's like, do we need do you need me pushing too many buttons? Okay. What I may do instead is I may say, you know what? some of these some of these are just straight automated. A lot of them are. So that's just simple ones. Maybe there'll be one or two portfolios where you say, okay, you can have automated, or you can have automated plus Rob does a little messing with it on the side. It might be as simple as saying, and again, this is why we need ideas, okay? It could be as simple as saying, all right, uh, we're always going to own, same thing, these 10, but it's going to be 80% of the portfolio. The other 20% is going to be Rob doing his thing, like a trading portfolio. We've thought of all kinds of ideas. The common denominator is we don't want to go forth with an idea, especially one that is active, and I'm willing to watch it and run it like a portfolio manager, like in the old days. Okay, just as a research provider, I'm willing to do all that and do all that work, but we have to know that there's enough people that are going to want it. And that's the reason we're still, we're putting a lot of stuff out and kind of seeing what hunts, if you will. But all of that is possible. Okay, let's see. Any more questions? Yeah, I like the idea of making money in a down market. To me, I I mean, anecdotal, but I don't know if the market is up, I don't know, 50% of the days this year. Um, Not in dramatic fashion, but I got to figure I'm up 65 to 75, maybe 80% of the days, with a portfolio like this one. Why? I mean, again, it was automated, but it was automated with 30 plus years of experience saying, well, what about if this happens? Or what about if that happens? Okay. Um, and frankly, if you want to see those types of things, I think you just download it. I think if you download this, it's going to give, no, it actually gives you the allocations. Oops. Okay. Enhancement request. It would be great to be able to download the actual, these numbers. It downloads, as a matter of fact, who was asking about that before? I don't know if you've seen this, but I mean, if you want to back test how good the Roar scores are, that's what you get when you simply hit the download button. It looks at all the ETFs and it says, oh, okay, it says here were the positions, okay? Not the Roar scores, but it's giving you the positions. So, Jim, you're kind of part of the way there. All right. If you know how to use AI, you could probably load this in AI and ask it questions and get a lot of that. Okay, let me see. 20 day, 20 day. Did I answer all the questions? Okay. Look at less fine tuning of the percentages in the 10 ETF. The percent stays at neutral weight or the current value unless something major happens or just once a month. Teresa, your perfect record is still intact. Because, yeah, that's exactly what I'm thinking. I don't want constant turnover in these portfolios. I only want to deal with the big moves. Now, again, it's possible that there are some investors that say, "Oh, no, 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 I want it micromanaged so that it's always readjusting." I think that's a shrinking pie. it's it's for the most part because like I mean, we'll probably attract a lot of newer, younger investors too, as well as folks that are kind of our demographic, and but those folks, they're too busy to do anything but say, "All right, I like that one, I'll put it in." Okay, and so everybody's common denominator is you can always do trades on your own. So why not make this a little bit more of a slow go? The other thing I will tell you, and this is me personally, what am I doing with this? Okay. Once I do get to that last step any week now, and I say, okay, this is now automated fully, the 10 ETF portfolio. No Wednesday look. I mean, I may look at it, but it would only be in like a really extreme case, like, hey, wait a minute, something's not working. Are you sure there's not a bug? Okay. Um, but what I say is, okay, because just so you know, in full disclosure, Dana and I have, one of our accounts that is over at Interact Brokers. We've been with Schwab forever. Everything. We took one of our accounts, we moved it over to Interactive Brokers. It serves as kind of a bigger version of the little model account we initially created, and I did that, with the idea that, hey, I'd rather it be automated. I don't want to have to, I can trade it easily through PyTrade, but it would be better to just let it go. Well, if I feel like, there is some short-term opportunity within that long-term portfolio. Hey, you know what? The cues look okay, but I'm a little concerned about the short term, and maybe this isn't gonna move. Maybe the allocation of the cues isn't gonna move down too quickly. Fine. I can go and buy something else in another account outside of this. This is what my clients used to do when I was an advisor. Rob, I've given two-thirds of the money to you to do what you do in a portfolio similar to this. The other third, I'm messing around, or I'm doing things that I believe in, or I'm, putting money in a few companies that I follow very closely, or whatever it is. Okay. Because the allocation is not just among asset classes, it's among function. What's pure do it yourself? You don't care what Rob or Roar or anything has to say. What part of it is, oh, I'm going to see what you do and trade it myself? And what part do you say, push a button, trade it? That's the idea. Let me see. Double exponential. Okay. You're Don. You are wise. You are wise beyond my years. Double exponential. It's yeah. I'm a very meat and potatoes technician. Okay. Let's see. Yep. 20-day moving average first sign and last. Okay. Last question. Let's learn more. Is this built to have a subordinate portfolio, your 10 ETF portfolio with one ETF allocated to another? Such as Pop 10. It's a different way to kind of say what I just did. And again, see, this is great. I mean, this is the reason we've gone 2 hours today, other than, I'm long-winded, the usual, is we're hitting on all of these growth issues for all of us. And one of them is like getting everybody to wrap their heads around, well, what are we actually doing here? We're building blocks of our individual asset bases and determining what their function is, which is what a good investment advisor will do. Not a financial planner, because that's more broad, but an investment planner, investment strategist, investment advisor. That's what I did. I was not a CFP. Is you have to figure out, well, not just what you're going to invest in, but and which accounts and whatever, okay? But what functions they're all going to play. And so, yes, that's one of the reasons I put this out, because I do want people starting to think, hey, this is my core. I didn't add this to it, but I'm sure we will eventually. This is my core portfolio, and I can tell you why. All right. And it's got, again, very low risk level. The second one I'm adding is this one, because I've always wanted to have it. Uh, I feel like I'm gonna maybe let the market get out of the way of whatever this current chaos is. Okay, that's just me, but I'm almost sure this is going to be in there one day. I'm literally lining up accounts for myself and for my family and saying, this account will be Dow 30, and of course some of them are automatically traded at pie trade. Some of them I want to have just in front of me because I want to go through the experience and try to fine tune it before we fully automate. But eventually, my goal is to automate myself out of existence, so that the trading stuff and the bond ladder and whatever. That's what I spend time on because I want to spend more time doing this. Teaching other people. Um, the QT pie. I mean, I can't help it. I came up with the name, but I'll probably have a little bit in these. But again, you know, I'm a conservative type, so this is going to be a core. This is going to be, if you will, a supporting. I have terms for these. This is a core or an anchor. This is supporting, and I would call these my tail positions. These two, maybe even this. It's going to be more volatile. Maybe not the pop stocks, but hey, it's going to be more volatile, and and as such, it's going to be a smaller position. And frankly, I mean, one of the cool things with pie trade is, and not all these are copyable, but if somebody's like, hey, I'd like to copy this model, just tell us because they can turn it on like that, if a few people want it. But um, the the being you if you can well, I think what happens if I recall a pie trade is we put our money in and then I said, okay, this much is going to this portfolio, and I have some in here, and now I want to put some in here. And it's as simple as you're in the app, and it's like this much to this much to this much to this. Hit a button, traded. That's copy trading. Uh, and yeah, as a matter of fact, one of our accounts was Dana's account, her IRA account. And I said, no, 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 I don't need to push the buttons for you. You be the trader. And it was like, oh, wow, so simple. So, anyway, lots of ways to do it. And you can see now we've really come a long way with getting everybody to the point where you can be whatever version of do it yourself investor that you would like to be. Any other questions? So yeah, totally. So yeah, I mean, it's core and explore. I will be writing more about, well, I'll be referring back to my old writing on that very, very soon because this idea of coaching people and creating their own portfolios, that is the issue. Okay. All right. Anything else? Thank you all. This was a great research and study session, and we talked about markets a bit too, and hopefully you learned something. Okay. Remember, as soon as you get a chance, I mean, we know Seeking Alpha is gonna handle the reimbursements. I mean, we have nothing to do with that. It's between you and them. But in 9 days, 10 days, we're going to be not communicating through the IG because there won't be one, and it'll all be through ETF yourself and obviously the analytics site here. Okay. Thank you all. We'll see you soon.